Hey everyone, it's Rob B here with Rob D, and you are listening to the Property Podcast, the market update. Interest rates have been cut. It's big news, but what does it mean for you as a property investor or an aspiring property investor? We get into that detail and bring you the stories that no one else is talking about. It's a great episode.
Welcome to the Property Podcast. Thank you for joining us. In case you don't know, we run a business that buys over £100 million worth of property every year for our clients. You can find out about that at propertyhub.net/invest. And we today are going to be bringing you up to date with everything that's been going on in the property market. And there's been a lot. Okay, so it's time for our market update, and we've got some good news coming up. It's been a good news month, but there is some potentially worrying news in there as well. We'll get to that as well. We'll get to everything, Rob, because we always do. There's only one place to start, which is the base rate. Finally, we've had a base rate cut.
We have. I feel like Coolio and the gangs Celebrate Good Times should be on in the background as we talk about this, but at last, it felt like it was never going to happen. It's been talked about for so long. But finally, the Bank of England have delivered. Only just. It was a split vote. It was very close. But the Bank of England, the majority of the committee, voted for a 0.25% cut. But they did say, do not expect this to happen month in, month out now. They want to wait and see what impact this cut makes, which I completely agree with. I also think you should do that on the way up, something that the Bank of England didn't always do, but on the way down, that is what they are going to do. But Rob, it doesn't mean we're done for the year. The market at least expects at least one more cut, which if it happens, would be great.
That's right. The market, of course, can be wrong. They've been wrong before, but that doesn't sound like an outrageous prediction. The thing that we're all going to be wondering, of course, is what this means for your mortgage rate. And I think the mildly disappointing answer to that for now is probably not that much, because this move was anticipated. So mortgage rates have been consistently drifting downwards over the last little while in anticipation of this move. So we may see some more lenders improving their offerings. Of course, if you're on a tracker or any product that is directly related to the base rate, great news for you. You've just had a quarter point cut, but I don't think we're suddenly going to see everyone go and reduce their prices by the same amount. Although if you haven't gone and looked at what's out there in the mortgage market for the last few months, because it is looking a lot better than it was.
I was also very nervous, Rob, because we made our predictions at the beginning of the year and we both had interest rates finishing the year in the fours. That looks like it still could happen, and for all our sakes and our gloating at the end of the year, I hope we are right. We, of course, will keep you updated, but interest rates is the type of thing that makes the headlines. You normally hear about it. But what I love getting into on this show is what that means for you, but also the stories that you don't hear about. Well, they maybe just touched on a little bit and you don't really understand the impact it's going to make. And Rob, something in the industry that's being talked about a lot right now is the house building targets. Maybe not the rest of the country's obsessed with it, but it certainly seems that the developers I'm speaking to are encouraged, at least, by this change of attitude from our government when it comes to house building targets. It seems to give them hope. It's not suddenly, oh, we've got a target, so we're all going to start building to hit it. It's not that. It's the belief that the government might actually do something to aid the builders to hit these targets.
So you're speaking to developers all the time, so you might be able to answer this. Because I think a lot of people don't really understand what the government says interacts with developers, because they can't force developers to build anything. It's up to them whether they do or not. So what do these new targets actually mean? Is it that developers were being held back in some way and now they're not?
It's planning. It's all about planning. That's what they all talk about. Their frustration with the planning system, whether it being under-resourced or the decisions made. The general feeling amongst the developers is that the planners are scared of their own shadows. They don't want to make decisions and they don't have the resource to make decisions. If it's a no-brainer build, it's on a piece of land that is obvious that it's allowed to be built on, then great. But anything outside that, which isn't a lot, means that they just can't get the planning through. And it takes forever. It takes a lot of local campaigning. There's a lot of effort to actually get builds off the ground. You think it would be just hard enough finding land that's priced well and then making sure you can build it for a profit. But no, that's only part of the battle. The battle that most of these developers are having is getting it through the planning system, finding land that the local planning authority are happy for you to build on. That's the challenge right now. Even with areas that are a little bit more forward thinking at the moment, like Manchester and Derby, you speak to people in power in those areas and they're very keen to do good things, but there still needs to be an overhaul, rapid change in the planning departments, because at the moment, that is the biggest blocker from these developers hitting these targets. It's not desire. They're ready to go. It's not funding. It's not as good as it was, but it's still there. It's the planning authorities.
And is this just a NIMBY effect? Why are they saying no? Is it because they're scared about local backlash?
I don't know. It makes sense that could be it, because it's easier to say no, isn't it? No one's going to fall out with you except the developer if you say no. Everyone else is going to be happy because keeping things the same is the easiest thing to do. It's not the right thing to do. That's a life lesson, not just a land lesson, isn't it? It's like staying the same and not progressing is the easiest thing to do in all aspects of life. And it's the same for these planners. So I think it's just playing it safe. I think they need to be encouraged from the powers that be, our government, to say, no, go, build, let's progress this and ignore the NIMBYs. You're not going to get in trouble for doing this. They need that endorsement. They need to be encouraged to build in areas that they've been uncomfortable giving planning on before. I'm not saying it's going to happen, but it's the most encouraged developers have been for a long time, and just sentiment improving is a good thing.
Yeah, it definitely is. I did see there was something in there about new towns, and a lot of this is about building in brownfield. It's about increasing density, but then there's also a mention of new towns. It's like, where have I heard this before? Every single time we've had a new government in the history of it. Are we all meant to be living in garden cities by now or something? This idea will just never die. But I think if I was to put a bet on anything, it's that this new towns thing will never happen. But hopefully the rest of it will. And it might seem weird to say hopefully, because I think a concern for property investors hearing about this might be like, well, isn't this a bad thing from an investor's point of view? Because it could tip the supply-demand imbalance. Like, surely if one of the drivers of house prices going up, which is what you want if you already own property, is a lack of supply and too much demand, then you don't want more being built. And that may be true in a general sense. But for me, at least, even if they do manage to build 300,000 a year or whatever the target is, it's still not going to be enough to make any meaningful difference. It's not going to show up in the price of your house at a national level. Maybe you own something next door to somewhere where thousands are all going to be built next to your back garden, but on a general level, it's just not going to make that much difference because there's so much catch up to be done, and the population is projected to go up by more than the amount that's being built anyway. So I really still see this as trying to avoid falling further behind rather than getting further ahead.
Without question, super sensitive topic, immigration. But last year alone, 700,000 increase net. This year, the target is to build half that amount of homes. Now, obviously not everybody needs their own home, but that's just last year's numbers. We haven't been building meaningful numbers for decades now. It hasn't happened. This needs to happen. And more importantly, it needs to happen in the right areas. I do like that there's area targets. It's not just a national target and just hoping that people go and build it on their behalf. Because if you do that and it did get built, it probably get built in areas where people don't need homes. But cities have got targets. A lot of these cities need more accommodation, but the right type of accommodation as well. I think there's an episode in this, Rob, where it's not just about building homes, but the type of homes built in these areas. Cities need communities built, not just boxes for people to live in. And some cities and developers are very good at that, and some not so good. Don't get me wrong, building's better than not doing anything at all, but then it's what you build can make a real difference. I think maybe we can park that for now because we've got a lot to get through, and there's a lot I want to talk about yet, but the type of build we do, that's definitely one for discussion on a future pod. Rob, we have to talk about, can't believe it's taken us this long, property prices, because we have more good news. I'm loving it. The sun's out and the news is good. Property prices are on the up.
They are. Well, we don't know if they're up according to Halifax because they are being lazy. They haven't put their numbers out yet.
Well, it is the summer.
Yeah, fair enough. Give them a break.
Might be on the hollybobs, Rob.
Yeah, we could all live without knowing whether it's down or up 0.1% or whatever. The world will keep spinning. But Nationwide have cancelled all annual leave and made sure that they get their numbers out. And we can see that house prices were up in July, up 0.3%. They were also up in June. And that leaves prices 2.1% higher than they were a year ago.
I think it's safe to say, Rob, that the commentators many of them, who said that property prices would be down this year are probably going to be wrong. I mean, the year's not done and anything could happen, but the trend is modest growth at the moment. So we're not anywhere near a boom, but the trend is on the up. And I'm really excited about the next few weeks of podcasts because we're going to be talking about the market. We're going to be talking about house prices. We've recently covered the 18-year property cycle, but we got quite excited by that. And thank you for the people who reached out after that episode. It was great to hear from you. what we want to do now is build on that, and house prices and what the future holds. We've got some really, really good stuff coming up, but I think it's safe to say that property prices, barring something dramatic, will be up this year. By how much? We'll see. We'll obviously keep you updated, but it looks like it's going to end in positive territory rather than a fall, which pretty much nearly every commentator said it would be. Some were brave enough to say flat, but most said a fall. I think they're going to be wrong.
It seems that way. And indeed, the latest home track data, which also came out this month, they are now saying that prices are on track to be up 2% higher over this year. That's not a prediction as such, but looking at their data and projecting it forward. But what could change this? What could knock it off track? The year isn't over. The only thing I can think of is some massive degradation in the economy as a whole. If we are indeed going to get this crash or correction or whatever it is people thought was going to happen, then that's the only thing I can see as being the cause. Because the adjustment to higher interest rates has largely happened. And I think it's fair to say that the market has weathered that far better than anyone thought it would. And that's maybe surprising, but nevertheless, it's happened. And sentiment is pretty good. Market activity is improving. It's not like the market is just sitting there flat because no one's doing anything. So we've got this housing market at the moment, which is sort of like neutral to positive, you'd say. It seems to me that unless you do get a big change, that's probably how it's going to stay. We might see some wobbles in the stock market because people are getting worried about the US now, and that normally has a knock-on effect elsewhere. So that might affect the stock market. But as you've often said in the past, the stock market and business is not the same thing. And the stock market and the property market are not the same thing. So I really think it is only like recession, job losses, big stuff that sends us back into negative territory at this point.
And I know you, Rob, and everyone listening will be reading the Deloitte CFO survey when that comes out.
Oh, yeah.
But the most recent one did say that the CFOs of UK businesses are the most optimistic they've been for a couple of years now. And they're the people in charge of the money, like, of these businesses. I don't know if you've met the people in charge of the money, but they're not always the most optimistic. So you'll have the CEO, which will always be the person who sees growth and opportunity, and the CFOs in the background crying, going, no, you can't spend that money. So for the CFO survey to come out, and this was last month, to be so positive, the most positive it's been all year, I think that tells us a lot about sentiments as well and how we can forward project the rest of the year. So I completely agree. If job losses do occur, then the property market could stumble or fall. But we seem a long way from that at the moment with where UK businesses are at. I think that it would have to take a big war event, which obviously none of us are wishing for, a replay of COVID or some sort of COVID, again, something that we're not wishing for, a big world event. I think to knock this off track now, yes, it could be job losses, but they seem quite far away at the moment. It'd have to be a world event, a very negative world event, to kind of take us off course at the moment, because sentiment, I think, is on the way up right now. The US, they've got a big election, and I think whoever wins, you'll just have that optimism afterwards. Again, I'm not straying into politics and who's best or any of that, because people get irrationally emotional over these things. But when you have leadership, and it will be new leadership, whoever is voted in for the next US president, whoever that is, then you tend to have confidence follow and optimism follow. So if the US goes in that direction, we tend to follow the US. So I do feel that this could be the beginning of a upward trend right now. And I'm starting to get to a point where I'm ready to reveal my thoughts on the property prices for the rest of this year and next in more detail. But we'll save it for those episodes we've teased. This month is a big month for the podcast. We've got some amazing content coming out. So make sure you are subscribed if you haven't done so already, and share it with others. We've got some good stuff coming out this month.
We sure have. And we've got some broader good news about the market, because it's not only us going, I think unless something strange happens here, we're going to be doing all right. Other people are seeing the same thing. So a big endorsement for the market that came out this month is from Aberdeen. I always want to call them Aberdeen because they did a rebrand. They took out all the vowels. So they were called Aberdeen. They're now called Aberdeen, which is the stupidest thing I've ever seen in my life. Anyway.
That's how you say it if you go to Aberdeen and have too many and then try and pronounce where you are. Where are you? I'm done.
maybe that's how it will happen. I don't know. Anyway, they've thankfully included vowels in their actual report where they have said that they have upgraded their expectations for UK real estate in general, and they've singled out the residential sector in particular. What they're basically saying is we've been light on our investments in real estate for the last couple of years because we saw the interest rate risk. Now that seems to be over. The adjustment has happened, and now it's back to the fundamentals. And in the case of residential, you've of course got this big supply-demand imbalance, which, as we've already talked about, is not going to end anytime soon, even if the government does incredible things in terms of house building. The other corporate recognition of market conditions that we've seen is Berkeley Homes, who are buying land again. They haven't bought any land for 2.5 years. They're now back in the market. I don't know, Rob, if that's because of the planning stuff or because of general market sentiment or whatever, but it's a positive sign because as a house builder, this is a long-term commitment. So the fact that they're coming back in and buying the land now means they must be feeling positive about where the market's going for the next few years at least.
I think it's certainly related to the targets. The article that we've got this from, the Construction Inquirer, and of course, I'm sure everyone is reading that already, a great publication. But in case you don't...
Only when you got to the end of the Deloitte CFO report. If you're still awake at the end of that, you start the Construction Inquirer. That's what I do at night anyway.
As soon as I wake up, Rob, I'm straight onto all my favourite websites. So, most people pick up BBC News. I'm straight into Construction Inquirer. And our friends over there have done a great job of reporting on this. And they've quoted the chief exec, Rob Perrins, who says that they strongly support the government's mission to build 1.5 million homes and welcome the steps taken to begin reform of the planning system. His words, not mine. So that seems to be directly linked to those targets. Interestingly, though, that developer predominantly, they do a bit in the Midlands, but predominantly builds in London and in the southeast. So you'd think the majority of those homes are going to be in London. And that's really interesting because if you said, okay, we're going to go and build 10,000 homes in Manchester and other places like that, then yeah, fine. You can see why Manchester's on the up and up. But London, as we keep reporting, it's not doing too well. And it hasn't done too well for a number of years now. So that is really interesting. We'll keep an eye on that. And of course, we'll keep you updated.
So lots of corporate enthusiasm around. But you know who's not enthusiastic at the moment, according to Hamptons at least? Landlords. Individual landlords.
Them blooming landlords, Rob. They ruin everything.
Yeah, landlords have had enough, according to Hamptons. But the picture they're painting isn't quite the same as what we've been hearing about a landlord exodus. Yes, there are landlords leaving the market. But what their data shows is not so much that everyone's rushing for the exit. It's that there aren't so many people coming in at the other end. So according to them, there'll be 113,000 new buy-to-let purchases this year, which is 40% fewer than there were in 2015. By the time you take into account those that are being sold this year, there are going to be about 30,000 fewer rental homes by the end of this year than there were at the start. And in total, private landlords will have sold more than 300,000 more homes than they bought since 2016. And that is quite something, Rob, when you consider, and this is a point that's either going to be in a YouTube video or will be in a YouTube video soon. I've recorded it, but I don't know when it's going out. But like fewer rental properties than we had in 2016. Look at the size of the population since 2016. It's up by a couple of million at least. No wonder rents have gone up as sharply as they have. It's hard to imagine a giant change in this dynamic. You could have more people coming in and getting enthusiastic about buy-to-let as the market settles down. I think you probably will. That could bring you back to even. But to get to a point where you're going to have a surplus, where you're going to have an increase in supply, that feels like a long way away.
It does, but it also creates opportunity, as we've talked about before. So I look forward to that YouTube video, Rob. What I do not look forward to is the prospect of higher capital gains. There's too many rumours about this, and when there's rumours, sometimes, when from the government, it means they're trying to get us all ready for an event. And this event could be that in October, the Labour government are going to deliver a budget and there is talk of capital gains going up. And if it goes up by as much as they're proposing, personally, this is my personal opinion, I think it'd be disastrous. It's 28% and they're talking of putting it up all the way, the top rate, all the way to 45%. Now, you could be listening to this and be in favour of it. I'll tell you why I am not. Because it will drive people out. It will drive rich people out. Now, understandably, from the business that we have, the networking that we do, I've got to know a lot of wealthy people, very wealthy people, and they are hugely frustrated by this. And you may think, well, good, we're going to get some of that money and share it around. but it's not going to work out that way. At least I don't think it will. They are already making plans to leave. Not saying they will. Some are on the way. Some are going already because of the things that have changed, non-dom status and things like that. And you might be of the opinion, well, good riddance to those people. But they're taking all their toys with them. And those toys could be businesses, employment. It could be wealth. And what happens with taxes like this is that the wealthy will navigate around it. And it's actually the middle classes who get stung by this. This isn't a tax on the rich and the wealthy. This would be a tax on the middle classes who aren't as sophisticated, who aren't as mobile. And that's what worries me. I'm nervous, Rob. Maybe I'm not seeing what this could bring, but certainly if I was looking to move to the UK and bring my wealth and my ideas with me, this would put me off. And if I was in the UK and I was in a privileged position and I can live wherever I want across the world, would I be saying this is the place for me to stay? And of course, it's got wider impacts than just the wealthy and what they'll do. It also could hurt property investors.
Well, yeah, I think the problem here is that they boxed themselves in a bit, because in the course of campaigning, they ruled out increasing just about every other tax there was. So you're left with capital gains and inheritance tax. So unless they go back on some of their pledges, which wouldn't necessarily be a crazy thing to do, they've got 5 years for everyone to forget about it. Unless they do that, then there aren't many places left over where you can get money from. You can cut some obligations, which is what they've done with winter fuel, and there are other places where they could do that as well. But you're basically looking at inheritance tax, pensions, I forgot to mention, and capital gains tax. Because on the face of it, you could say, oh, well, you're making gains and you're getting taxed less than someone's making on their income. Someone who's going out there and working hard, and your gains are being taxed less than that. But that's not quite right, because the thing about capital gains is some of it, quite a lot of it, comes just from inflation. So if you were to tax capital gains at the same rate as income, but put an indexation allowance in there, which is what there used to be, then I'd actually be pretty supportive of that. But I suspect that wouldn't increase the tax take and might actually reduce it. So yeah, it's a tricky one. I think they will do something with CGT because there isn't much else that they can do. But I agree with you, Rob, that they've got to be careful. And I think there's a limit to how much it can raise anyway. So we'll have to wait and see. We'll have to wait all the way to the 30th of October, in fact, to see what happens with that. But I think it's highly likely we'll have to see some kind of announcement of some kind on capital gains tax. But if that does indeed happen, then there are one or two things you can be doing. There are some strategies that you can use to work around that. If that puts you off the idea of selling your properties, but you still want to realise some gains from them. So we'll talk about that podcast in the future. Unless they scrap capital gains tax completely. And if that's their big announcement, we won't talk about that because it'll be irrelevant. But otherwise, we will.
I'm excited about sharing those strategies with people, Rob. I'm also excited about Hub Extra this week because the majority of this episode, hopefully, has been uplifting. And if you want a show that's going to uplift you, possibly inspire you, then I've got one for you. You may have watched it already because it's quite a popular show. But Rob, I spoke to you before we started recording. You've only watched one series of this. I really encourage you to go back and watch more. The show is called Race Across the World. It's a brilliant programme by the BBC. It's one that my whole family sits down to watch. It's amazing. The most recent season has just finished. I think it was season 4. And it was one of the best ones yet. I think season 1 was amazing. Season 2 was really good. Season 4, really, really good. And as you'd expect from the title, it's about a race across the world, different parts of the world. And it pits different couples together. So there might be friends, it might be mother and daughter, it might be a married couple, and of all different ages and backgrounds. And they are given a little bit of money to get from one place to the other. And they have to meet checkpoints along the way. And they have to be smart with this money. They have to pick up jobs along the way. And it's great. It's a competitive race. There's big money on the line for these people at the end. But what I love just as much as seeing amazing places that these people travel through is the personal journey these people go on. Now, you may be listening to this going, oh, come on, Rob. But I promise you, it's inspiring. It's really uplifting. This last season, season 4, my heart felt full afterwards. And that is a great feeling. So if a TV show can deliver a feeling like that, you know it's a great TV show. So check out Race Across the World. If you're only ever going to watch 2 seasons, then do 1 and 4. But it's worth going through it all, I promise you. That it is a great, great show. Love it. Highly, highly recommended.
I agree. And I'm normally not one for the whole X Factor journey thing, but you're right. Seeing the transformation is really quite something. And I can turn this into a double recommendation. So I remembered now where I heard about this show. It was actually on the podcast, The Rest is Entertainment, which is a fantastic podcast. Then they're talking about how they filmed this and the lengths that they go to keep it completely true to life. Because obviously if you had a full film crew with you, it wouldn't be quite the challenge or quite as real as it's made out to be. But they go to incredible lengths to make it really real and to make sure they really are in those situations that you see. So they clearly put loads of effort into this show and it pays off.
It does. So it's on BBC iPlayer if you want to check it out. Amazing show.
It's such a shame that no one pays us to advertise on this show, because that would have been a really good ad read if we're being paid for it, but we're not. It's just a recommendation. But never mind. Maybe one day we will get paid by someone. But in the meantime, that is us done for another week. Thank you so much for tuning in. We got you up to date with everything that's happened in the last month. And if you want to be the first to see what's going on in the property world, I write a weekly newsletter, which will hit your inbox every Friday if you sign up at propertyhub.net/pulse. So if you are subscribed to that already, I'll see you there. If not, see you back here next week. Bye-bye.
Bye-bye.